somebody who takes someone, puts them on a platform, somebody who builds out the business and provides the infrastructure that David and his team would also provide as well. And if they could only start some mutual funds, it would be terrific for us. And we could kind of just upstream this. And what's important for our business is that by the time you bring them into a distribution type entity like ours, or somebody where they can supply capital into their investment product, it comes sort of in, like drinking out of a fire hose as opposed to bits and pieces, because what ends up happening is they have to have that infrastructure in place. They have to know the limitations of their product capabilities. They have to kind of know what their capacity is, and they have to know the timing of their capacity. So from our perspective, having folks that are already in the market trying to weed through folks that do it well is a tremendous benefit to us. Having a mutual fund entity is another aspect of it, because when you plug and play into the mainstay platform, which has grown to $80 billion, pretty much from $20 billion 4 years ago, it really comes with a lot of opportunities for these folks. We approach the business very similarly to how these guys do. We do not like taking 100%. I mean, we kind of say that our perfect highway is between 60 and 80% ownership. We have a few franchises on our lineup that were bought years ago, I guess, and they were bought at 100%. We've worked hard to try to get equity ownership back into the hands of the management. That's not always an easy thing to do once you've sort of crossed that bridge. There's a lot of tax implications, and there's a lot of things that make it complicated. So ideally what we would like to do is buy from, not always a founder. It could be somebody that has a minority position, and the two folks that are sort of at that point where they're looking at transitioning their business into the next generation, but still have a number of years to run. So we would like to buy that, that equity ownership from them. And if it starts at 60%, that's great. If it needs to be 80%, that's fine too. But ultimately, we wouldn't want to be above 80% because we always want management to have skin in the game as a. And what's the last thought on this is that this 60 to 80 is really dependent not only on where they are today, but also on the growth prospect and the size of the business. So that can have a heavy influence on that.
Great. And David, I guess just on the opposite side of the spectrum, your firm primarily takes minority positions, and so do you just want to maybe just drill down a little as to why it is you guys prefer that on the flip side?
Sure. Yeah, I think when we launched in 2000, the concept of taking a minority stake was somewhat novel. Jay was in the deal business. I think all of us were doing deals back in the 90s, and it tended to be a bit more binary, either all or nothing, or control or not. We kind of, my previous life was a consultant and advisor and a banker to asset management firms, and I think we realized you never really own an asset management business. The best, it is a people business. The assets go up and down the elevator, all those sayings. And so the best you can do is align your interests with the management team. And alignment of interest can take many different forms. We like to do it through equity. We think the equity incentive is the most tangible tool to keep people thinking like owners, have a long-term focus on business development, on wealth creation for themselves. But I think what you see here at the panel and what you've seen in the industry is an evolution on that thinking. So this concept of alignment can take place through equity, it can take place through revenue shares, it can take place through other delivered value, whether it's distribution capabilities, sub-advisory opportunities. In our model, we want to partner, as I mentioned before, with teams and firms that want to run their own businesses, that are willing to build the capabilities, the non-investment capabilities to help grow their own business, invest appropriately in that. We use equity as the alignment tool. The primary portion of the senior people's compensation will come through their equity distributions, as will a big component of our return. So our interests are aligned in that component. We tend to be more transition capital. So the capital we will put into a deal early on to buy from a parent company or an owner will make sure the company can be independent and autonomous for a 5 to 7 year period. Whether they want to merge or sell the business towards the end of that period is their own issue. We can talk about our exit strategies down the road. But we view the business as basically we are partnering with the firm for a period of time, and then they can grow beyond our capabilities of their own as they see fit.
Thank you, and we'll raise those exit strategies in just a minute. And Spiros, has historically, how have you guys structured your acquisition.
We're
or
a bit
investment
unique
managers?
here, and we differ a little bit. Ultimately, we don't pay an equity multiple to get ownership in the businesses. We invest partner capital as LPs for GP stakes. So we leverage that acceleration capital in their vehicles, not in their GPs, plus the infrastructure and distribution, and hopefully good business advice by partners like myself, to be able to get a stake in the businesses which are go-forward partnerships. So ultimately what we'll tell a manager is, what you've built to date is 100% yours. We had nothing to do with it. But if you agree that we're partners that can add value going forward, then we will invest with you day one. That will earn a passive rate of return. We will then hopefully grow your business, and if we succeed, you should want to be partners with us over the long haul with no exit strategy. Again, the view is we want you to be a TIG-sponsored fund for the duration and your entire career. And ultimately, we've had 5 managers that have stayed with us longer than 15 years. That's our goal.
Okay, great. Thank you. So I guess the next question would be for each of the panelists is that over the last several years, we've seen acquirers structure their purchase prices such that they have these kind of deferred mechanisms in order to incentivize the managers that they're purchasing. And so I guess the question for each of you would be, how do you each structure your purchase price, and what kind of mechanisms, if any, do you use specifically to incentivize your targets, your managers? Jay, you want to speak to that first?
Okay.
Put you on the spot.
I was going to have David go
You
first,
want-
so
okay.
I could
David,
go
you want-
ditto, because we'll probably be very
I think we'll be
similar.
pretty similar on this.
Yeah. I think it's interesting because people would not think of a large acquirer as being somebody who would be flexible, but it's one of the advantages we have. And fortunate enough to have some of the bankers that I've worked with in the room today so they can kind of attest to this. What we do is we look at what the opportunity is, and we hopefully would be able to align our interests with their interest. And we're okay about giving up some of the upside growth. That's important. We do, if that's and we'll give capital, or distribution or other things in order to achieve that. What we want to do is, and maybe this is a slight difference in these folks, is even if we were to buy a portion of the equity up front, we want to get ourselves in sort of the quote path to control. We like to, if to the extent that we would separate equity from economics, I think that's kind of an important thing for us. We don't want to have to go through sort of that approval process twice, once when you buy the initial stake and once when you get above that 50% level. So being able to get that structure right. But as far as structuring the economics of the deal and the transaction, we're quite flexible. We would happily pay for a portion of it up front, and we've structured deals where the payouts are in 4 to 7 years time hence. We don't, we've lost prospective opportunities when someone came to us and said what they wanted was 100% sale of their business, and we said we couldn't do that. The most we would be willing to do in that case was 80%. They didn't like that. They tried to achieve 100% sales, so that's not something where we find alignment. We don't typically look at earnouts, although you could call the way that we do it as sort of a earnout type function. So, and generally speaking, it can be as simple as saying we'll buy a third here, we'll buy a third couple years hence, and we'll buy the remainder in 7 years' time, and we'll pay you a multiple off of those percentages based on where they are and how they grow the business. So.
Are you going to say ditto, David?
To some extent, ditto. I guess I'll say a lot of our negotiations are a little bit different. It's not as straightforward as a buyer and a seller. Many of ours are kind of three-way negotiations where we essentially want to get to know the management teams, the people who want to own their own business and need our capital to buy their businesses back. And I know there's some lawyers in the room. I probably can't use the word collude, but essentially what we do is it's in our collective interest to negotiate the best possible deal from the parent company, the owner, the departing partners, whoever it might be. The less we can pay up front, the more equity we can put in the hands of the management team. So that leaves the third party, the quote-unquote seller, and these aren't hostile deals, but they're not always really friendly deals either. Usually being the one who wants some sort of earnout. So we will obviously negotiate a back end and earnout if necessary or if possible, but we try to avoid that. What we really want to do is have whatever growth or good experience we have with the portfolio company to accrue to our benefit, but also to the management team's benefit. So we're going to be cautious about how much we pay up front, and to the extent the firms grow and experience growth on or ahead of some plans and budgets, we'll establish some milestones where we will dilute our equity in favor of management. Essentially a growing pie theory. We're happy to be a smaller part of a growing pie. So we always want to start with a minority stake. That can be as little as 15-20%, as high as 49% in some transactions. As firms grow, we literally will give equity back to the management team to reward them. And that has a couple benefits to us. One, it's a way of rewarding management, and we all benefit from the growing pie. It helps the management team that initially launched the firm with us to provide equity for their next generation, their junior employees who are coming up. And as we talk about our exit strategy, it also makes our exit strategy more affordable if one of their options is to buy our equity back. So as far as the other party at the table for the negotiation, the quote-unquote seller, we have used earn-out structures, some milestones to help them get back to a more full valuation if things go according to a certain plan. We just try to keep those as small as possible and as short as possible.
Great, thank you. And Spiros, how do you guys incentivize your managers?
Yeah, ultimately, we offer more equity to managers with success. As the businesses grow, we accrete more of the economics to the portfolio manager, with the theory being that we want more of the economics in the hands of the manager to grow a successful investment team. And our view is similar as David described it. We want to own 20 to 30% of a multi-billion-dollar business as opposed to 50% of a $100 million business, right? So ultimately, the view is put more of the economics in the hands of the portfolio managers as they succeed and grow the business, so that they can build the right investment team to continue growing assets and performing the way we expect and want.
Okay. And David, just to drill down on that, Rosemont doesn't take a permanent position like you had mentioned. You guys have a rather unique kind of put feature that you have. Do you want to just talk about that a little and just explain how that works in practice?
Yeah, sure. I think unlike my colleagues up here, we do need an exit strategy. Unfortunately, our funds partners want their capital back someday. So we're very clear about that when we do our initial deals, and we say that there's usually a 5-year horizon. That's not a firm deadline, but after the 5th year, we need to start having a conversation about what is the end game for our partnership with our respective portfolio companies. One way of addressing that up front that we think is critical is we have a put right in all of our deals. It's put in place with the understanding that ultimately the end game is in management's hands, not in ours. We could come to the table with a buyer willing to pay a ridiculously high multiple for a portfolio company, but if the management teams that we've partnered with have no interest in working for another employer or selling their business, it doesn't do us any good. And we respect that and we understand that. And so going in with saying we're backing this business with a premise that it's going to be perpetually independent and employee-owned, we need our exit right, so therefore we have a put. Usually it's after the 5th anniversary of our investment. We pre-negotiate all the thorny details. What is the multiple applied to earnings? How is it going to be financed? And if we exercise our put, we will provide seller financing through a note structure. The actual form of the note is embedded in our operating agreement. We try to leave as little to ambiguity or chance or negotiation. It's very transparent. And what that does is it really forces a conversation, usually around the 4th or 5th anniversary of our investment, about how are things going, how's the team gelling, what are the prospects for the firm. And in about half of our exits, we have exercised our put and we provided the financing. The other half, our put has been the catalyst for the firm to think about what do we want to do when we grow up. That has been, in some cases, sell just Rosemont's stake to a third party that provides some other benefit to the business. In some cases, it's been selling a majority stake. But ultimately, although the put right is our option, we view it really as management's option. Management's going to be the group driving the ship as to what they want to do. And we facilitate that through a put.
Great, thank you. Spiros, do you want to talk a little bit about kind of the selling points that TIG offers, and what are the advantages and benefits that you guys are able to offer an investment manager that would make it lucrative for that person to want to join up with you?
Yeah, so if you think about a go-forward partnership, ultimately we don't cannibalize any of the economics of the current business. The view is that we would be able to offer you an infrastructure improvement day one with an infrastructure that's been operating consistently for 30 years and has been vetted by allocators globally. So now allocators will be able to look at your strategy and get a sense if they want that investment exposure and have checked the box on the operational front. The second thing is likely we would offer a distribution expansion. And if you think about, most of the managers have 0 to 1 folks fully dedicated to marketing. It's really the portfolio manager that's doing a lot of the heavy lifting here. Typically, the portfolio manager in that conversation pretty quickly understands the value creation that TIG can add to that conversation. Thirdly, we say we're looking for an autonomous run your business. We are looking to be your partners go forward. And if you talk to our portfolio managers, they'll all say, my firm, my fund, we encourage that. We are not looking for people to be subsumed into TIG and all is dictated by Spiro and the management team. This is a mutual growth plan that we put in place and that we talk about and agree upon on an annual basis. So it's infrastructure improvement, it's distribution improvement, hopefully, and we have to do mutual due diligence on each other, right? We don't cannibalize any of our strategies. So if, for better or worse, we pick somebody in the event space or long-short equity space, we're going to stick with that manager, and oftentimes we've got a reputation of being overly loyal, but that's part of the model as well, right? We can attract top-quality portfolio managers because we're loyal, in good times and in bad. And as an example, I can give you now our largest fund, which is north of $1 billion and has had a great year and done well from a performance perspective, has been with us for 22 years, hasn't had a down year. In 2008, came to us and said, and was up 1.5%, started the year with $450 million, ended the year with $80 million, and said, now what? I've got a team of 6, I've done everything right, and the world doesn't care. I'm an ATM, what are you going to do? And I said, we'll support you. Today, the business is north of $1 billion, and that's the value of loyalty, at least from our perspective, and that's how we run it.
I'm sold, Spiro.
That's right.
So, and Jay, not to disclose any obviously confidential information, but it is public that New York Life has entered into a deal to acquire Dexia Asset Management for 380 million euros to, I guess, increase your presence in Europe and Australia. Do you want to just speak briefly about what interested New York Life in that investment, and what are some of the challenges that you're going to face in terms of being kind of multinational there?
Yeah, no, we're very excited about the opportunity that would come with Dexia Asset Management acquisition. We have been, as we talked earlier a little bit about, trying to find products that we can distribute for in the U.S. marketplace. Global and international equity and fixed income have always been sort of at the top of that list. So we've been pretty active in visiting folks both in the U.S. and overseas, trying to find those capabilities. Also strategically thinking about how we want to grow the geographic reach of our current business. We've done well in the U.S. We had to get that model right. We had to have our boutiques running and being efficient and getting to this right appropriate size with the ability to garner assets. We had some capabilities to fill there, and we had done all that. Had started to turn our attention to sort of more of an international view. With that came an opportunity to evaluate Dexia. At that point, we were primarily interested in Europe. We hadn't really formulated a full opinion on Asia or Australia. It's one of those situations where we got involved in the process. We were very intrigued by it, very interested, but wasn't quite there. Fortunately, the deal did not get consummated at the end of 2012 into early 2013. They came back to us, asked us if we'd be interested. At that point, we had already crossed over on a number of the different initiatives. We were in a much better position. Felt that there was a couple of really distinct advantages you would not ever be able to gain in any kind of internal organic growth development. That being a UCITS platform, that being aligned distribution with a strategic partner in the banking systems over there in Belgium, France, and Luxembourg. So for us, it was the ability to be able to do that. There were not really many people interested in that transaction, so we had that advantage as well. So for us, it was great. I think there'll be a number of different challenges as we begin to grow this business, but I think more than challenges, there'll be huge opportunities, and we're pretty excited about being able to take our U.S. boutiques and begin to market some of their products across the seas. So we're looking forward to that.
Thank you. And David, I guess in a similar manner, Rosemont took a position in Silk Invest recently as a boutique manager that invests in the Middle East and frontier Asia and some of Africa. Do you want to maybe just speak briefly about what interested you and why it is you guys think that kind of business will prosper?
Sure. I think, along with, I think I said earlier, that we don't really go out with a shopping list for a particular asset class or style that we're investing for. We look first and foremost at the business. That said, I think everyone in the room would recognize that it's been tough sledding for generic large cap U.S. equity asset classes, core U.S. fixed income. If you're not doing something somewhat differentiable, it's a challenge. And we had an opportunity. We followed a frontier markets manager called Silk Invest, based in the UK, for over a year. Liked their investment approach, which was bottom up, boots on the ground. I think there's 14 passports and 16 different languages spoken among the team. And thought their approach was differentiable, their process was sound, and the team had invested significantly in their own business. So somewhat unusually for us, we provided growth capital to that business. I think I mentioned normally we're transition capital, buyout, recapitalization. In this case, our capital went to help them build out their U.S. sales and distribution efforts and to help tighten up their balance sheet, which we thought was a catalyst for some business interest. That said, just to contrast that deal, which was a little unusual for us, another one of our most recent deals was a management buyout from a Fifth Third Bank of their core U.S. asset strategies, all their core U.S. equity, growth, and value. Fairly generic product set, but it was an attractive valuation in a management-led buyout, and what differentiated them was not so much their product types as their client base. They were very well tied into the Taft-Hartley and the public fund universe. So when we did the client consents, we joke about it, 120% of the clients consented because we actually won business during the transition because the clients were so pleased to see this firm take their business back. So in that case, it was a situation of sales and marketing, client contacts, and relationships trumping asset class, which made the deal attractive for us, the team especially, and for their clients.
Great, thank you. And Spiros, I believe the TIG is looking to launch perhaps a new product that's going to invest in managers around an AUM of, say, 100 to 500 million at some point in the future. Do you want to briefly discuss, kind of what attracts you to that size and how you plan on structuring that for yourself?
Sure. So most of the 28, 30 years of the first 33 years of the firm's history have been about partner capital, seeding strategies, building a record, and hopefully building a successful business. Over the last few years, we've really started focusing on acceleration of managers. And the advantages from our perspective are that you've got an investable record you can actually review and see how people did in August of 11. You can talk to their team and see how that manager, even though they may or may not be a great risk taker, how do they actually interact with their investment folks? And then you can talk to an investor base and get a sense of how transparent, how trustworthy is this manager in times of stress and in times when things are going well. That, for us, de-risks the transaction. Also, the manager is given an indication that they can raise capital, invest well. So as we thought about that opportunity set, we've done 3 transactions in that regard where we accelerated managers and they've worked relatively well. At the same time, we were talking to the investor community and felt there was a dissatisfaction with respect to emerging manager mandates. And part of the concern wasn't the opportunity set or the expanding opportunity set when you think about 2,000 managers in that subset, finding the right ones. It was really a function of how do I write the appropriately sized ticket when I have to go to my investment committee and I need them to be 100, 150, $200 million tickets. And ultimately these managers are $100, $200 million to begin with. Another thing we heard about was how do we get a risk aggregation of these managers that are using different disparate systems that oftentimes aren't tracked by the consultants that we usually use. Third bit is how do we source them? Oftentimes investment teams are really stretched. So as we thought about the opportunity set and described it, and thought about the challenges that some allocators were facing with respect to their emerging manager mandates, what happened was one of the CIOs of a state pension liked the idea so much that they joined the firm. So we structured a product around that particular activity and said, look, if it was appropriate for you, would it be appropriate for others? And as we thought about it and had the initial dialogues, which are ongoing currently, it's been thankfully very well received in the marketplace, and we're hoping to launch Q1 with a $500 million initial close for that fund. And the view is that it'll be a diversified multi-strategy of 6 to 8 managers that are in the $100 to $500 million range, mainly long, short equity, discretionary, and global macro. And one of the things that we want to differentiate ourselves are using our partnership model. We want those initial investors to be partners alongside with us. So we're offering them one layer of fees, which are founder share class economics, and we're offering them the same economic interest in the underlying managers as we get. The idea being now you can benefit from the growth of those businesses like we can benefit from the growth of those businesses. All interests are aligned.
Have you launched that fund already?
We're currently ongoing. We're in. It's moving well from an investor sourcing perspective. We're in the finals presentations coming in Q1 for 3 relatively large mandates. So we're hoping to close at Q1.
Nice. Well, thank you. I guess, and just finally, in terms of questions for each of you, and we can start off with Jay. Do you want to just talk briefly about what you've seen in 2013 in terms of the activity and as it might have compared from 2012 and the prior years, and equally important, any idea on the forecast for the future, and are you optimistic about the investment management M&A space?
Yeah. It's been a very busy year for us in 2013, and it's been actually the last several years have been relatively busy trying to add the capabilities that we wanted to add. We're somewhat agnostic as to what's going on in the rest of the world because we're looking for some specific things. We're out there trying to find those, and if it's available in the marketplace, we'll take a look at that. If not, we'll go out and seek it out. So I'm not sure what 2014 will bring, but it's probably continue similar to 2013 right at this point.
David?
And we've definitely seen a pickup in activity, both in terms of deals closed, but also just in terms of buzz, activity, inbound calls, dialogues that are progressing more quickly in terms of teams thinking they're going to leave. Part of that's probably buoyed by the confidence in the market and where things stand. We're also a little bit agnostic as to the deal flow. We kind of view the deal activity in asset management a little bit like the circle of life. Larger firms often acquire businesses, they absorb them over time. Some entrepreneurial teams may split away. That creates opportunities for us, and the cycle tends to repeat itself. But right now I think we're on an uptick in terms of the overall cycle.
Great, thank you.
We've seen over 400 teams this past year. I think that'll increase next year. I think there's lots of managers right now that are contemplating how they're going to deal with the regulatory burden. That's thankfully not exponential anymore. I think it's going to be a linear growth, but I still think it's going to be a burden that's growing going forward. I also think investors are placing significant demands, so the barriers to entry in the business, even if you are at $100, $200, $300 million, are still pretty great. So I anticipate that activity in this particular subset of the universe, in the alternative investments, $0 to $500 million, is going to increase going into next year, and I think for the next couple of years.
And we've intentionally skipped off of any regulatory-related questions for our panel, so fear not. Thank you so much, gentlemen, for your time. I guess we'll just turn it around to everybody before we conclude and see if anybody has any questions for our panelists. Anyone? Yes, please.
Two quick questions. David, on that Silk Invest transaction, was that something that you all did solely, or was there a management co-invest or another local or foreign co-investor with you on that?
No, we did that exclusively. We're the only outside investor in Silk Invest. The balance is management's own pocketbook.
And then if someone would comment a little bit on your sense of some of these crowdfunding teams and some of the derivatives from that, I'd be curious as to there.
Questions on crowdfunding?
We don't normally look at crowdfunding, but I did see a presentation about a month ago of a website that ultimately had managers incubate their own strategies. So these are the folks who are, I think they're called frontier traders, is the industry term that the folks who have left Wall Street by ultimately based on their own desire to have more flexibility and run their own capital, and they're wanting to prove the thesis. So they're allowing investors to access their returns on a real-time basis through a central technology platform. So you can access hundreds and hundreds of these managers to get a sense of, and they're operating on their own capital, from anywhere from $3 to $20 million of their own capital, sometimes out of their garage, to try to generate investors by watching them trade in real time, be able to see how they perform without the granularity of their positions. So I think that's potentially the crowd sourcing. I have not yet seen, I'm curious if you guys have, crowdfunding for operating capital and initial startup capital for hedge fund businesses. I'm not aware of that yet.
No, I'm not.
We haven't seen it as a source of funding, but we are seeing kind of a retailization of certain emerging managers through essentially a crowdsourcing model. Small managers who would never be able to access the retail market who are being collected in a collective vehicle with some boundaries around their trading strategies to go to market.
Thank you.
Thank you.
Thank you all.